Good morning or afternoon, wherever you are in the world. I'm Zach Comis with Founders First Capital Partners. Thank you for joining us today for Innovating for Equity in an Uncertain Economy, the State of Social Justice Impact Investing. Black, brown, and women entrepreneurs are starting companies faster than the national average. But for too many, because of access to the right capital and networks, scale can sometimes be out of reach. A new generation of impact fund managers, especially led by people of color, are tackling this gap head-on with innovative alternatives beyond the typical debt or VC playbooks, helping investors and philanthropists connect their mission to their portfolios. Today, we'll have a chance to hear from leaders on both sides of the funding ecosystem. First, with a panel of leading fund managers who are leading the way on capital innovation. Second, by the asset owners who are helping fuel that impact. And finally, we'll have a chance for Q&A at the end. So please put your questions and comments into the Q&A or chat box at any time. I'll make sure to get to a few at the end. I'll now introduce our co-hosts who are grateful for their partnership on this event, starting with our visionary founder and CEO, Kim Folsom.
Good morning. I am so delighted to be with you. I'm Kim Folsom, founder, chairperson, and CEO of Founders First Capital Partners. And I am delighted to welcome you to our conversation. We've hosted several educational sessions like this, and we're heartened by the outpouring of support from all of you for joining, as well as we want to really thank our co-hosts that have come together to collaborate in sharing this thoughtful discussion today. That includes ImpactAlpha, Mission Investors Exchange, and the Rockefeller Philanthropy Advisors, and our panelists for making this possible. We're very grateful. I would be remiss if I didn't start by sharing with you a little bit around, my why of, getting into the space as a serial tech entrepreneur. I founded Founders First in 2015 with an ambitious goal of funding 1,000 diverse founders who have systematically been excluded from capital and want to do this by 2031. So I've got some work to do. We're seeking to pioneer combining non-dilutive capital with methodologies like revenue-based financing and high-quality advisory services to help more diverse-led businesses transition to become mid-market companies. And when they achieve this goal, they'll be able to create and retain more premium wage jobs and wealth in their communities and have that change of those local economies, as well as offering a reliable returns to mission-driven investors. And as part of this work, we're working to build that alternative finance ecosystem. And doing so, we also collaborate with other fund managers, CDFIs, investors, and funders to bring this flexible, innovative finance to more companies that are often left out, especially those led by women and people of color. I look forward to our conversation today. And at this point, I'd like to transition to one of our co-hosts, Nick Alameda from the Mission Investors Exchange. Take it away, Nick.
Thank you, Kim. And thank you for the opportunity to co-host today. Welcome, everyone. My name is Nick Almeida, as Kim noted, and I'm with Mission Investors Exchange, also known as MIE. MIE is an impact investing network of foundations, other philanthropic asset owners, and partners. Some of the panelists today are members. Impact investing with the social justice and racial equity lens is really one of the core parts of MIE's work, as well as the work of our members. In addition to the theme being a core part of our Baltimore conference most recently, we work on a number of different programming with our members on the topic and related topics. And we also developed a racial equity resource library, as well as other resource libraries that you can check out on our website. Thank you again for everyone participating today. And with that, I would like to hand it over to Patrick at Rockefeller Philanthropy Advisors.
Thanks, Nick. Appreciate it. Delighted to co-host this webinar. I lead the impact investing work at Rockefeller Philanthropy Advisors. We essentially help asset owners navigate this question of integrating their investment and impact goals. really with a groundswell of interest in this idea of racial equity investing and innovative investment vehicles that really blend both goals inherently in their structure. I like to phrase myself as a recovering white male, really here personally with a learning mindset to learn from the panelists today. So grateful to be included, and we'll pass it over to Dennis at ImpactAlpha.
Thank you, Patrick, and thank you, Nick, and especially thanks to Kim and her team for convening this discussion, and for all those tuning in. We can't see you, but we know you're out there. As Zach said, out of the pandemic, we've seen a surge in entrepreneurship in the US, primarily a surge led by Black women and other diverse founders. That's created a tremendous opportunity, not only for the economy as we move to majority minority population in the coming decades, but for investors, and also an opportunity to take this head on this financing gap that has for too long excluded diverse founders. In the data, we've seen that the concentration of venture and banking capital in a few regions and with a few types of founders and types of companies that has been hard to budge. But today we're talking to fund managers building out new models to fill this gap, as well as some of their earliest and influential backers. I will say at ImpactAlpha, we are seeing a surge of these types of investment strategies that are figuring out how to plug gaps for diverse founders, as well as a tremendous interest from our readers and subscribers. So let's jump in. Let me quickly introduce our panelists, and then we'll move to some back and forth discussion. First, on the fund manager side, we have Allegra Stennett, the co-founder of New Majority Capital. Hi, Allegra.
Hi, Dennis. Glad to be here.
Welcome. Todd Leverett, founding partner of Apis and Heritage. Hi, Todd.
Good afternoon, everybody. Hey,
good to see you. And of course, Kim, who we heard from earlier, Founders First. We'll come back to you all. And then representing the investors and LPs and other funders, Thaddeus Fair, the Assistant Director of Living Cities. Hi, Thaddeus. I think you're on mute, but that's okay. Stay there. We'll come back to you. Susie Lee, the program-related investments officer at the WK Kellogg Foundation. Hi, Susie.
Hi, everyone.
John Baalbeck, Director of Impact Investments at MacArthur Foundation. Hi, John.
Hey, Dennis. Hi, everyone.
Good to see you. And Kate Costa, the Vice President of Global Small Business Philanthropy at JPMorgan Chase. Welcome, Kate.
Hey, everyone. Thanks for having me.
Let's jump in. Allegra, I wanted to start with you. New Majority is perhaps the newest fund manager of the group. You're putting a new inclusive twist on an established business financing model. Tell us about it.
Sure. So New Majority Capital, we're an impact investing fund that's focused on closing the gender and racial wealth gaps by providing training, but also capital to BIPOC and women entrepreneurs. So typically, these are entrepreneurs that are buying or looking at buying businesses ranging from $1 to $10 million in revenue. And we have an accelerator that we run. It's an 8-week accelerator to give them the training to do so. And then the capital to buy the business up to 100% of the capital, which is unique on the market.
So these are entrepreneurs that would come in after a business has started, more of an established business, and take over leadership.
Yeah, they're typically buying businesses that have at least 5 years of operating experience. We're seeing typically the owners they're selling from, if they're not the original owner, have owned the company for 20, 30 years.
New Majority is sort of surfing this so-called silver tsunami we hear about of owners, business owners over the age of 55 seeking a succession plan. There's something like 3 in 5 businesses in the US will seek a sale in the coming decade. And it turns out private buyers are, more so private equity firms can only meet a fraction of that demand. Can you talk about how this presents sort of a non-obvious opportunity for wealth creation for diverse entrepreneurs?
For sure. So over the next 25 years, it's estimated that 12 million businesses will be up for sale. And so that's a unique opportunity that we see for people who traditionally haven't had access to capital, to get that capital to acquire these companies, scale them, and then build generational wealth. So it's a direct way of building wealth, no matter what age you are. And that's something that we've actually recently seen, is that people who are, say, 50 years old that haven't had that opportunity, they can also buy a business, scale it, and pass down something to future generations. So within the matter of a year or 2 years, you can transform your wealth creation drastically.
I think these non-traditional pathways to entrepreneurship are a theme today, and it's sort of exciting to see, because I think not everyone wants to start a business from scratch or has the resources to, or the time. So love that. You've also undertaken a really neat strategy to raise your own funding. Can you share a bit more about that?
Sure. So we're currently raising $50 million, which will be used to help the entrepreneurs in our pipeline acquire these companies. We're really excited to have established some partnerships with Momentous Capital, with Live Oak Bank, that is co-investing alongside our fund. And so that'll extend the number of investments that we're able to make in helping these entrepreneurs. We have 3 financing models that provide from anywhere from 0% down payment to whatever the entrepreneur may have as a down payment. So we're really excited about offering this model to our entrepreneurs.
I was also thinking about the community round that you're raising.
Yes, yeah. So that's for the management company we're raising on WeFunder. So that's for non-accredited investors. You can invest in New Majority Capital Management for as little as $200 on WeFunder.com.
It's kind of a neat reframe of crowdfunding in a way, the idea of drawing from your customers or community, and have them have an ownership stake. And even for that, you do have a catalytic or lead investor that's sort of anchoring that, correct?
Yes, RSF, Social Finance, they're our lead investor. We've really excited to have had them play that role in addition to some other things that we are innovating with them on. So yeah, they are our lead, and excited to continue the partnership with them.
And you have a few upcoming deals that are closing. Are you able to share anything, give a little preview of those?
Yeah. So we have almost 200 entrepreneurs in our pipeline, and several of them are at that LOI stage. A few of them are closing this month and next month. And so just to give one example, we have one entrepreneur in Atlanta who's acquiring a $3 million healthcare company, and he plans to do what's called a roll-up strategy, which is acquire more of the same type of company, roll them up under one owner, one company, and then scale that way. And so we're really excited for him to close and to begin that process. It's going to be his first acquisition, but not his first time being a manager of sorts. So really excited for him and for the others in our pipeline. We have another entrepreneur in Houston acquiring a $3 million healthcare company as well. Actually, healthcare is really hot right now. And so we're, just super excited to have these entrepreneurs close, to have more entrepreneurs come into the pipeline and get to that stage where they're seeing the transformation of their business. And we run a succession ready program for business owners. And now, having been a few months out from that, we launched in the state of Rhode Island. We're seeing business owners now come back to us and say, hey, I'm considering selling. And so between both of our programs, we're able to have a level of proprietary deal flow and see that transition happen in real time.
Fantastic, Allegra. Hang around. We'll bring you back in a moment. Todd, I wanted to jump to you. Your model at Apis and Heritage is also in some ways riding this silver tsunami of established businesses seeking buyers and exits. You've identified a group of people that also may make natural buyers of these established businesses. Can you tell us about that?
Yeah, that's right, Dennis. And that group of people are the employees, the people who have worked with whoever the founder was for however many years, making that business run, and not just upper level management or C-suite, but all the employees at the firm. So as Dennis was saying, Todd Leverett, co-founder of Apis and Heritage Capital Partners. We're a sponsor of our first fund, Legacy Fund 1, which is a $58 million fund that looks to create more employee ownership in this country, specifically looking at those diverse workforces with a large number of BIPOC employees. And we're using this model, we call it the elbow model, the employee-led buyout, to really directly address the racial wealth gap. That is largely caused, as we all know, due to housing, but is also largely caused due to business equity and retirement accounts. So we use a combination of employee stock ownership plans, ESOPs, and the principles and practices of co-ops to help convert privately held, closely held businesses to employee-owned using our investor capital. So we're as New Majority Capital, directly addressing the silver tsunami, giving founders exit opportunities that they didn't know that they had, while also giving workers wealth building opportunities and communities strategies for keeping jobs and great companies locked in place.
Again, this sort of theme of alternative pathways to wealth for entrepreneurs, not necessarily building a company from scratch, but at least working at a company potentially from scratch, but accessing ownership in other ways. The ESOP, employee stock ownership plan, and you mentioned there's a bit of co-op values in the model. Can you sort of unpack those terms and models a bit and say how they and share how they work?
Oh, Dennis, I think I'm so sorry. I froze up. As you know, I was inside. The fire alarm went off, so I had so I think you wanted me to unpack the ESOP versus co-op piece of it a little bit.
Yeah, or how the elements are working together.
Yeah. So you know, ESOPs and co-ops both exist in this world of employee ownership. ESOPs are known to be more in the world of tax incentives for sellers, more kind of white collar kind of corporate tax strategies, whereas the co-op really comes more from the grassroots world of communities who have tried to use enterprise to help solve a problem for communities. So it comes a lot more from historic roots in Black and brown communities and communities across the world. But essentially what we've done is brought these two models together. An ESOP is one of the oldest forms of employee ownership in the United States. It is the cousin to the 401k. And essentially what it does, it allows workers and companies to hold their ownership, their shares in a trust account, similar to a 401k. And the workers, as they work there, they vest into the account. As the value of the company grows, the value of the shares grow. And when it's time for that worker to exit the company, either through retirement or they get fired or they leave, then they're able to essentially put their shares back to the company and receive back the value for those shares. And there's some really tremendous and powerful tax benefits that come along with the ESOP model. For example, a company that's 100% owned in the S-Corp ESOP doesn't pay any federal taxes, and in 44 out of 50 states pay zero state corporate taxes. And there are some awesome, pretty strong incentives for a selling owner. On the co-op side, co-ops are really built around the Rochdale principles, where 7 principles that are basically rooted around how can a business help take care of the workers at the business and help take care of other worker-owned and cooperative businesses. So really using models of human-centeredness, worker-centeredness, and sharing of information and education, and sharing of risk and reward in companies. So that's kind of an oversimplification of both, but bringing these two worlds together and pointing those resources, that power at workforces and workforces of color, we think are going to be part of not just closing the racial wealth gap, but also closing the quality job gap in this country.
Do you have any data? How many ESOPs are there in the U.S., or what is sort of the trend that you're seeing that you said, there's an opportunity here?
Yeah, so ESOPs have been around for over 50 years, and co-ops, we say have been around since the beginning of humankind, cooperative models of the enterprise. But sad to say, in the U.S., there's really around maybe 7,400 employee-owned businesses using the ESOP and the co-op model. And there are other models out there, but probably no more than 8,000 businesses in the U.S. that use some form of employee ownership. And this is really at the core to why A&H existed. We asked the question, why? If it's a business model that owners love because they get to preserve their legacy, take care of their workers, if workers love it, if communities love it, why aren't there more employee-owned businesses? And the conclusion that we came to, there are several, but one of the primary issues is that there's not enough capital that understands these models, understands the benefits of these models for growing companies, for preserving companies, and for being able to actually get return on dollar from the investments. There's not enough capital out there that gets it and understands it. And so we came out, we saw that opportunity and that friction, and we brought our great community of investors around and say, hey, here's the model, here's why it works, here's why it makes better companies, and here's how you can have a good return on your dollar while also creating huge impact. So we're bringing that there, and hopefully we'll be a bit of a model along with some of the other teams out there. In 10 or 15 years from now, you won't need us. You'll have banks and CDFIs and other traditional financial institutions doing the same.
Financing ESOPs. You mentioned earlier you're fresh off your own first fund closing. Can you talk to us a bit about how you secured that early funding and what it meant for the fund?
Yeah. You know, I promote this model a lot now. Apis and Heritage Capital Partners started off as a project at a national nonprofit known as the Democracy at Work Institute, or DOWI. And DOWI is a national nonprofit that focuses on what are the strategies, what are the ways to help Black, Brown, and all marginalized communities access the economy and take care of themselves using models of employee ownership. So the original project was go out and figure out how to scale this for owners of color and workers of color. The conclusion we came to is that the missing piece was capital. And then what we did is really pull on the world of supporters and funders of DOWI, including the Kellogg Foundation, who have been supporting DOWI for a number of years and have been providing grant funding to DOWI, to say, hey, we have an investment model around this. And really starting with our base of funders at DOWI and building out from there, we were able to build one of the best rosters of impact investors, including Kellogg, including the Rockefeller Foundation, including Ford Foundation and others, Robert Wood Johnson Foundation, to really allow us to do this kind of seed fund, this first fund, and prove out the model and prove out the team. So, you know, thankful for our great group of investors, which is includes a lot more people than what are named, but
And just briefly, can you give us a flavor? Like you've made investments from the fund. Can you just give us a flavor of what types of businesses those are?
Yeah, so we focus on, we call them essential service businesses, essential service and essential manufacturing. So those businesses where you're going to find a lot of your Black and brown workforce. And one thing that COVID really did was shone a spotlight on these workers who really keep the economy going and keep the economy moving, but are also oftentimes go unappreciated and aren't given the opportunities to build wealth the same way. So, you know, to date, we have 2 companies within our portfolio. One is well, when we began, it started off as a 115 person landscaping company, commercial landscaping company in El Paso, Texas. Right now, they're at about 160 workers. Since the acquisition, but a commercial landscaping company in Texas named Accent Landscaping. And we also have started off as 60 and now it's going up on 75 person plumbing company, a commercial plumbing company in Denver, Colorado. So your landscapers, your plumbers, your waste haulers, your commercial cleaners, folks who are working in the factory, everybody who's keeping this country going and needs the opportunity, and the places where you find a lot of your Black and brown workers.
I love it too. And I mean, even at ImpactAlpha, we cover a lot of VC investments into, impact tech companies. These are not those types of businesses, but there's ways to you're having tremendous impact and addressing, wealth gaps. And so I think it's good for investors to hear these types of about these types of models. Also, Todd, hang in there. We'll come back. Thank you. Kim, you like to say that founders first. We've been using this line for years. You said it to me once. You like to say that founders first is majoring in the minors. Can you explain how your particular model and type of finance works for a broader set of businesses in the economy?
Certainly. It's based on 2 realities. On the one side, there's so much hype around, venture financing, which is okay, but the reality is, less than 5% of capital of that venture financing, even though as of last year was over $370 some odd billion. Less than 5% of that goes to Black and brown founders. And definitely, when you add in, women of color, it's just substantially low. And even though they're just as capable of providing, many, outcomes, but folks are in the venture capital area focused on the specifically the unicorn company. And but the reality is such a small percentage of those companies become unicorn companies, those over $1 billion. But there are the companies that likely may be 8, 9, 10 figure companies that can be great employer-based businesses and wealth creators in their community. And those are, if the unicorn company is the grand slam, those companies that are, large, small, and mid-market companies, these are the singles and doubles. And we call them the cousin of the unicorn, the zebra companies. And so for every, unicorn, you have, thousands of these, zebra companies. And it can even be a more significant multiplier when they are provided the right relevant capital, know-how, and connections to grow and thrive. And that is the area in the diverse business ecosystem that we seek to develop and grow those businesses and help them, get those doubles and singles. And with that, the other component is it doesn't require you to have a big liquidity event in order to build wealth for neither the investors that participate nor the founding company operators.
And let's come back to how exactly that works. But you mentioned know-how and networks, I think, in addition to capital. Can you explain how that in the diverse founder community, why more than capital is often needed and overlooked sometimes?
Sure. I came to this work as a six-time tech founder before this, and started my first business in the crazy.com era. And, there was more than capital, but there were connections and know-how that was provided to a lot of really great tech founders to help them grow and thrive. And when you compare that to the, BIPOC communities, having someone who can provide you with, 6 figures of capital, in addition, can connect you to your first customer, can go through and share, this is the type of organization that you need to have in place to be successful at that big customer, to help you get the next 10 to 50 to 100 customers. And those are the components that are really important. And when you look at the traditional VC, ecosystem, that is, the smart money that's provided to those tech companies. It's the capital, connections, and know-how to help you thrive and grow. You think of, accelerators like, Y Combinator, Techstars. They help provide those other components to help those companies thrive. And that is something that we recognize that's important to help the businesses we work with do so as well.
You recently, or maybe not so recently, but have closed a different type of fundraising round for Founders First itself. Mm-hmm. Can you talk about the importance of investors backing the operating business itself, the Founders First itself?
Yes, it's really super important, because the other piece that's necessary is the validation of alternative models. And this is the great thing about our discussion today, is looking at this various level of innovation to address the gap in growth capital, and that there's so many different ways to solve this solution. With us using a revenue-based model to fund growth in diverse businesses, you need to have a capital ecosystem that makes that happen. And us being able to attract the support of leaders in the philanthropic market, such as the nation's biggest, philanthropic organizations and family offices, and supporting our, ability to grow, as it provides a platform for us to fund, the goal of the 1,000 businesses, but it also demonstrates to other diverse business owners that it's possible to attract that level of funding. And I would also like to share the way that we used our funding with our Series A. It was a type of revenue-based financing. So it's really being able to continue this level of demonstrating this use of this innovation to be able to fund and grow these businesses.
And I want to come back to you mentioned the from the investor's standpoint, it's just slightly different because it's not the Series A, but the from the revenue-based standpoint side, that's going into actual businesses. You said there's no need for an exit for investors to get their return. In a way, it's sort of fixed income like returns, but they're also equity like in a way. I'd love you to explain that. But it's interesting that it comes at ownership in a different way. It's allowing owners to business entrepreneurs and business owners to maintain ownership in their companies, correct?
That is very, very true. As part of building the whole wealth creation in the communities, it's more of a structured exit, and it's a shared, wins and more aligned interests with regards to that model. When you use that revenue-based financing model, the traditional equity model assumes that you're going to make an investment, and at some period of time, when I started my entrepreneurial career in the dot-com era, it could be a 3-5 year term to exit. The realities of today, it's more 7, 10, 12 years to exit. Where revenue-based financing, it's more of a structured exit because as the company is generating cash flows, there is the revenue share, if you will, of those, and so that revenue share goes along the way. And as the company increases their revenues and the value of the business, the investor is able to participate in that growth along the way in a structured method, as you talked about, from more of a predictable income stream, experience for the investor, which is a great thing. And that capital can be recycled back to make additional investments. And then the other thing, it also addresses the challenge in the market where people say, well, I haven't seen this being used with this model being used with diverse funders to help grow those types of businesses. And so that can be demonstrating that model there as well.
Thanks, Kim. I want to bring back in Allegra and Todd for a brief discussion. The title of the webinar acknowledged the uncertain economy, and I'm wondering how the macro environment, inflation, interest rates, recently the collapse of Silicon Valley Bank. Can you talk a bit about? Could you each of you briefly talk briefly about how the current climate is impacting your work positively or negatively?
Sure. So I'd say, on one hand, thankfully, some of the things that are happening in the VC space aren't impacting us as much. But with that said, I think it's definitely shown a light on the fact that we need to be a little bit more diverse in terms of the things that we're investing in. And so from that perspective, I think it has actually attracted capital to the ETA, entrepreneurship through acquisition space.
We as in society, the economy, need to invest in a broader set of things.
Yes, for sure. And so I think one of Kim's points needs to be definitely illuminated. So 75% of VC-backed companies fail. And so we have individuals on the call who are perhaps investing in VC funds or manage investment portfolios. I think we need to juxtapose that statistic to any other industry, medicine, healthcare, aviation. In no industry would that statistic be okay. And so I think we need to ask ourselves, really self-reflect regarding our investment portfolios and ask ourselves, why is that okay? It is definitely the sexy thing, but it's not sustainable. And for people of color, it is really impossible to get that capital. So I think the current market has definitely shown a light on that. And we are definitely moving forward in terms of preaching our message of small business acquisition. So I think I'll stop there, pass it on to Todd.
Yeah, I'd say kind of two major ways that impact us the most and how we do our work from kind of everything that's been going on in the broader macroeconomy. One, the increase in interest rates, the very sudden rapid increase in interest rates does have a big effect on what deals can get done, what can be financed. the product that we use is a mezzanine product. So it has debt-like aspects to it and equity-like aspects of it. And often our transactions do involve senior lenders as well. So as those interest rates go up and you plug those into the model, the number of companies and opportunities that actually work actually gets smaller. That said, we're dealing with a part of the economy in the lower middle market, companies between call it $2 and $6 million, $2 and $7 million of EBITDA, where it's just one of the widest parts of the market, right? And for Fund One, focusing on those types of companies in this environment, we have there's still many targets out there, many opportunities. The industries we focus on are also very, very fragmented. So there's a plumbing company, there's a landscaping company, there's a commercial cleaning company out there that's doing well, and that likely has a founder who's looking for an exit option that they can feel comfortable with and they can be happy with. So it does have an impact on financeability. On the other side, the last year and the volatility and everything that's happening, when you're having conversations with business owners, a lot of folks who had their company on the market at the beginning of the year took it off market to see what was going to happen, right? To see how things were going to play out. And now I think we're at a point where folks are starting to put their businesses back on the market. They see that this is going to be not a short term, this is not as transitory, all the things that are happening as everybody had hoped. And folks are really getting worried. And a lot of folks don't want to go through another recession or have to hold on to their business for another 5 or 6 years. So we see a lot of willingness from owners to now go ahead and sell their businesses, even though some value expectations are still off. So those are kind of the two big things but again, with the types of businesses that we're dealing with, essential services, they're going to be around, they're going to stick around, and they're going to do well or at least survive during any recessionary periods that are coming up.
And I would add to that, so at Founders First, many of the companies that we fund are corporate suppliers that have, long-term contracts with their customers. And so, these are, at worst case, essential services or, must-have demanded services or technology that's used to support these companies. And, the reality is, given the, uncertainty in the inflation market, our portfolio companies face, two kind of interesting, challenges. On the one side, when the economy gets the flu, diverse companies get, pre-vaccine COVID is the reality. And so being able to demonstrate that they can be thriving and they have a source of capital that's consistent. And then our model is designed to allow investors to have a consistent way of returns, which is important in certain markets like this. And our model is designed to provide a stable cost of capital, which allows us to provide growth capital to diverse founders at reasonable rates, even in this particular market. So that's our approach and our perspective on this.
So inclusive, but also resilient in an unstable market. Thanks to each of you. I think there is opportunity to speak a bit towards the end, and there's some good questions coming in from the crowd, so we'll check back in. But want to move, we've talked about these innovative models that are emerging. Let's talk to a few of the investors that have been at the forefront, often with flexible risk-taking capital, of seeding these emerging fund managers. Thaddeus, I wanted to start with you in Living Cities. We've mentioned the new majority as a company, but also as a concept and a trend. Living Cities has built an entire investment thesis to test innovation for the new majority. Can you talk a bit about your family of funds at Living Cities?
Sure. Thanks everyone for having me as well. Sorry for being on mute earlier. So yeah, we've developed a family of funds called the Catalyst Funds. We started in impact investing in 2008 with our first fund, originally focused on low-income communities, and we're doing that as some community revitalization projects, scaling CDFIs, which were a bit nascent at the time, and testing pay for success projects. So that was Fund One. We started Fund Two in 2015 on the heels of Fund One to kind of carry forward that mission. And also Living Cities is a bit unique in the sense that we're a bit of a research organization as well. Quickly realized that if we wanted to support low-income communities, it was hard to have any sort of success doing that without an intentionality around race and demographics, given the demographics in those communities. So we shifted our focus to cut across both lines of business, our program area and our impact investing area, to focus on racial equity and inclusion, and namely helping to close the racial income and wealth gap in American cities. And so what that meant for Fund 2 was going to the investors and saying, hey, can we do this with your capital? We didn't say we're going to do this with your capital. Is that okay? And then they graciously said yes. So that meant tossing out the pipeline we had, going and identifying and closing on a pipeline that we thought would help to contribute proof points to closing our AI gap. And so what that led us to was changing the demographic access to capital. And so we look to support diverse fund managers and those that also support diverse fund managers, and to put diverse fund managers and founders at the decision-making seat of who gets access to capital. So we looked at the ways we could do that. First two funds were structured debt vehicles. So it's very difficult to do equity out of a structured debt vehicle. So we learned that we were very quickly forcing a debt-like product into an equity needing structure, and so what we did a lot of work around some debt structures that could help diverse fund managers and founders get off the ground, and then that led us to starting our third investment fund, which we're currently raising now, which will be $100 million equity fund of funds to support diverse fund managers, because we really, there's a stat that came out from the Knight Foundation that less than 2% of capital in America is managed by women and people of color, and so to Todd's point earlier, we asked why, like why is that a thing? Why does that happen? What can we do to change it? And if and the bigger through point is, if you're looking at America, the demographic shift in America that's happening, in a matter of a couple of decades, the demographic shift in America will be that America is dominated by people of color, and so if you're going to economically be viable, you have to change the access to capital for people of color, because if not, doing so is essentially investing and going out of business, because the demographic shift.
And what you're saying is not just access to the capital, which is sort of the, or at least a step towards the end game, but actually the decision makers and the folks who call the shots of where capital goes in investing in diverse fund managers.
Oh, absolutely. I think that even personally, it's one thing to get capital and access to capital in the hands of founders like, say, Kim Folsom, but it's a different ball game to change who is in the allocator seat, and doing that is often more galvanizing for changing the other end.
You mentioned that Living Cities research mandate as well. So my understanding is you're trying to demonstrate some of these models, whether it's a fund or a fund manager. What sort of things do you look for traction to say this is working?
One, we look at even like Kim's story. It was when I first joined Living Cities, I was flabbergasted by like the fact that she was a serial entrepreneur, successful, and we were like, why is I understand like the risk model of someone first time hanging out their flag and starting a business for the first time, but like you're talking about a serial entrepreneur that's been successful. Like, why is that more risky, or why is that perceived to be more risky? And we're trying to change the perception of risk and how we as allocators like price risk, model risk, understand risk, hedge it, and structure around it. So a lot of that is testing points of what real risk is, what, say, skin in the game really is, and how do we juxtapose against the racial wealth gap in America? How do we create structures that also, while they allocate capital responsibly, and also manage fiduciary responsibility to our investors? Because we're unlike, not that the foundations don't do great work, but we're not a foundation. We have in our funds, we have
managers,
right. We have a manager. We have 11 investors that want their capital back. So and it's our job to be fiduciaries of their capital. So we look at it in a different lens of like, how can we A, protect investor downside, but B, push the envelope a bit to say what is true risk, what is true mitigating factors, and what's extractive versus allocating capital responsibly.
Love it. Redefining risk is another theme. Got to move on. Thank you, Thaddeus. I'm going to bring up Susie from Kellogg Foundation. Susie, inclusive entrepreneurship and ownership to close racial wealth gaps. How does that fit into Kellogg's strategy? And has it increased as a focal point in recent years?
Thank you, Dennis. Yes, it is a focus and it has increased. And I'll start. To begin, children are at the heart of everything we do at the Kellogg Foundation. And you might be wondering what transforming the capital markets has to do with children. And essentially our answer is everything. And it's supporting thriving children requires building a whole economic system that's inclusive for all. And we believe that advancing racial equity in the capital markets is essential to driving equitable opportunities for all. So that's sort of the high level framing around the foundation's why for this work, and more specifically around our investment focus. Back in 2008, the Kellogg Foundation launched our mission-driven investment program. We invest out of a carve-out from our endowment to target market rate returns for our mission-related investments. And we also invest out of programmatic dollars, which are more catalytic and flexible. And we utilize that philanthropic capital for our program-related investments. And over the last 15 years, we've committed more than $300 million in investments to achieve strong financial performance and measurable impact, all with a racial equity lens. And in recent years, in response to the critical needs, in the racial reckoning, as well as the COVID-19 pandemic, which had a disproportionately negative impact on communities of color. In 2020, we increased our payout by approximately 50% for an additional $300 million that we deployed over a 2-year period starting in October of 2020. And on the investment side, that really gave us more capability and capacity to double down on our investment thesis. And in terms of volume and pacing, and being able to invest in these urgent needs and meeting these needs in the capital markets. Last year, we made a total of 14 new investments across our PRI and MRI portfolios, deploying a combined total of about $50 million. And that was 3 to 4 times the pacing in dollars and deals from prior years. So we're really, again, deploying more capital, doubling down on our thesis, and frankly, the marketplace of investable opportunities, which we're seeing here on this webinar right now, has really increased. So the availability of, again, high quality investable deals has increased, and we have tried to increase our capacity to invest in as many of those opportunities as is feasible. And
Kellogg's has backed 2 of the funds here, Founders First and Apis and Heritage. What attracts you to sort of the innovative approaches, or even from first-time managers in a way, as opposed to other types of ways to come at this?
Sure. I mean, again, we believe that prior solutions haven't worked. The market is broken. And so innovation and new models and new approaches are really essential in, again, closing the racial wealth gap, making the capital markets more equitable. And, it's been mentioned, Thaddeus touched on this too, around reimagining and rethinking risk. And that is really core, a big part of our why in supporting innovation is that, structural and systemic racism have just created paradigms of perceived risk that have prevented capital from flowing equitably to communities of color and to fund managers of color and to women fund managers and entrepreneurs. And this is driven by bias, both conscious and unconscious. And these, again, created these huge barriers and resulted in the statistics that we've been discussing, which is, again, just a few percentage points of capital flowing to BIPOC and women-led funds and companies. And so, again, being able to pivot and stretch our tools to take on more risk. I think Founders First is a great example where we were able to not only make an equity investment, we invested in the Series A, but also make a direct investment This is again stretching our ability to use that PRI tool, which historically has been very much a debt vehicle, right? People think of PRIs, they think of long-term low interest loans, which are still essential, and we're still doing a lot of that, but being able to really optimize and stretch that tool and say, yes, we can invest earlier, we can take on more risk, we can make direct investments. The majority of a lot of the new investments we've made on the PRI side have been equity. So again, we're utilizing all the tools in our toolkit to be able to invest in these opportunities. And we've also leveraged our programmatic side too, where we've made a companion grant to the nonprofit organization that does a lot of the business support. So Founders First CDC. So again, really trying to use all of these tools to unlock the innovation that's necessary. And in terms of APIS and heritage, that was a really interesting one where for us, it was really important to make a market rate investment out of our MRI pool. That one was a very interesting one where we were looking at it as a potential PRI. And then again, their model is commercially oriented, and we ended up making an MRI, but, we're rethinking and hoping to help our, and learning from our peers and hoping to continue to build this approach in the ecosystem around rethinking, for example, track record, and looking at lived experience, looking at relevant industry expertise as other drivers of future success. I think in the traditional investment paradigm, you say, well, has a fund manager done this exact thing before and been successful? And if the answer is no, we can't invest in a first-time fund. So really trying to stretch and expand the criteria, which will again help shift that risk paradigm. So we're doing enough with both of our tools.
Thank you, Susie. I appreciate that. John, I want to bring in from MacArthur, which has been all about closing capital gaps. It's been your mantra, like the one for business finance for diverse founders. Can you talk about, and Susie just touched about it a bit on how Kellogg is approaching it, but how do you deploy sort of across the capital spectrum to close capital gaps?
Yeah, thanks so much, Dennis. And maybe first of all, thanks to you and well, thanks to Kim and Founders First for organizing this, and thanks to you and the ImpactAlpha team for the coordination here, and also for your in-depth and thoughtful coverage on this important topic. And a shout out to Todd for somehow managing to do a webinar while he's dealing with a fire drill. So that's very impressive. So for us, Dennis, we're looking at this issue as sort of an olive foundation approach, and so we're trying to invest across a full continuum of capital, full spectrum of capital. So that starts with we are looking at grant making that we're hoping to deploy here. And so looking at grants to support inclusive entrepreneurship in Chicago for efforts like TechRise, the Fund for Equitable Business Growth, and to support diverse managers through efforts like VC Include, Black VC, and Latinx VC, among many others. So grants are an important tool. We're also looking to deploy catalytic capital. And as Dennis, I know you know, and others on the Zoom screen know, we look at catalytic capital as a way to address capital gaps. And so we're looking at the catalytic capital we think of as capital that's willing to take disproportionate risk. It's willing to accept a concession in order to achieve a certain type of impact and to mobilize additional forms of capital. So we're looking at that to address critical capital gaps like innovation, like hard to reach people and places, like challenging business models. And we're using that as a tool in this particular area. And if you look at Kim and Founders First, for example, Kim's addressing just a pernicious capital gap that as it relates to early stage equity, for managers or for entrepreneurs of color. And that's, as we all know, that stems from a history of intentional policies that have prevented the creation of generational wealth in communities of color that doesn't allow for friends and family capital, which is the typical form of capital for those early stage entrepreneurs. So to us, support for an innovative model like that is not in support for the innovation in itself, but it's the innovation to address the capital gap, the end of it, sort of addressing that capital gap and showing a model that can help move solutions forward around that gap. And then the last area along this sort of full spectrum of capital is we are supporting through our core investment portfolio. We are supporting diverse managers as well. And at MacArthur, we look at this as within our impact investments portfolio, we're managing an allocation that's a carve out from the endowment. So a $500 million carve out that we manage for the catalytic capital investing. That's our impact first portfolio. And then we're also managing a returns first portfolio. And within that returns first portfolio, we are doing work to support diverse managers as well.
How do you gauge success in a fund? Because you have these sort of broader goals and the same idea of demonstration effect or catalyzing additional capital. What are the metrics you're looking for success of a fund investment, but also that idea of closing a capital gap in the economy and the market?
Yeah, it's such a good question, Dennis. And what we don't do, we actually pretty strongly believe that we can't aggregate metrics across the entirety of our portfolio. Instead, what we do is we start with the specific theory of change of the program that we're trying to support, and we look at the ways that a financing solution can specifically address that theory of change, that problem area. So we identify the specific gaps within that program, and then we look at ways and then we're trying to bring, it's a problem first, tool second approach. So we're looking at the problem, assessing the problem, and then looking at the right financing solution, whether it's innovative, whether it's traditional, debt, equity, guarantees, and we're looking at the ways that we can address that problem in that way. We do track progress towards the outcome. So when we sort of assess the specific goal and the target for that particular program, we then assess over time progress towards those, and we track that at the portfolio level through a heat map that looks at sort of how we're progressing across each of these different areas. But again, equity and inclusion is a through line through all of our work. And so, how we're looking at, say, our climate justice investments within our climate solutions programs, or our vital community investments around racial equity in Chicago for our Chicago commitment, or our supportive housing work for our criminal justice program, or our support for Indigenous autonomy. Those are unique and specific to each of those different programs, with that through line of equity and inclusion as sort of the North Star for the work.
Thank you, John. And we are heading to the top of the hour. We do go to my time here, 12:15, so another 15 minutes. But I wanted to bring in Kate Costa from JPMorgan. Kate, support for small businesses and particularly small businesses led by founders of color is a large part of your strategy at the philanthropic arm of JPMorgan Chase. How have you approached this from a strategy standpoint?
Yeah, thanks for having me. So I sit, as Dennis mentioned, within global philanthropy at Chase, and we have essentially 4 areas of focus, but really they're driven by financial health and the racial wealth divide as the goal. And then our other pillars are more like strategies under that. So my team focuses on business growth and entrepreneurship as a means to build wealth and tackle the racial wealth divide. There's also a team that does jobs and skills. There's a team that does neighborhood development, which is largely housing affordability. But again, all of it is coming back to, and what's the financial health impact on the household of the people that we're serving. So when we think about small business or entrepreneurship from that perspective, and then we think about access to capital, one of the things that we've been really, really pushing on for a number of years is trying to change some of the conversation from the capital providers that serve community from saying, here are the types of capital we have. Now, how do we get the entrepreneurs to use them? And switching it to what are the types of capital that different entrepreneurs need at certain times? And then what can we do to help either support that product development or support like the design and distribution of how that capital is going to flow to entrepreneurs? And one of the main ways we try to integrate that is by using all the parts of the bank to help identify what really needs to stay philanthropic and what can move to the market. I obviously work in philanthropy, but kind of, I can't remember if it was Thaddeus or Todd earlier saying, at the end of the day, though, philanthropy is kind of a Band-Aid. We need to get solutions into the market in order to have sustainable impact on the communities we're trying to serve. So a super simple or practical example of that is we might have, if somebody is raising a loan fund because, or if a CDFI is raising a loan fund because they want to test a new product, we might come in at all layers of the capital stack. So our community development bank, which is just a market-driven line of business, might come in as a senior debt holder. Our impact finance team, which provides concessionary capital, might come in as subordinate debt. And then our grants team might come in to support something like a loan loss reserve and or staffing. But the goal of that, right, is they're testing this new product. So sure, we'll put in loan loss reserve so they can prove out the loss rate so that the next time around they shouldn't need to raise the loan loss because they've proven out what they're looking at from that product. So that's really how we think about collaborating across the firm. And so when it comes to innovative financial models, the thing that we're really poking at is which of these new financial models has the potential to become a widely used market offering, and how do we prove that case out if that's how it's going to work, and then which of these are always going to live in philanthropy, and if they live in philanthropy, what are the other approaches we can take to scaling there?
Another theme, capital across the continuum to address these gaps that a few folks have mentioned. With Founders First and Entrepreneurs of Color Fund, which is another, I think, big success case for you all, there's this important local component, especially when serving diverse business owners. Can you talk about going local and why you've chosen that strategy?
Yeah, so we consider it global. So if you remember the way I described our work, we have actually teams within philanthropy that have a geographic focus and work across all of the topics. And then we have others of us, like myself, that have a topic focus and work across all geographies. And the reason for that is because we think it's really important to have sort of that high level strategic view, what's really cool happening around the globe, what's showing great initial results, but we need to test if it's scalable, and how can we effectively achieve economies of scale on some of these products. At the other end of the spectrum is the folks on the local team saying, here's what I need for this population in this neighborhood in my city right now. And so the way I think of it, I'm based in Chicago, so the way I think of it, if I'm talking with the Chicago team, my job is to make sure that I know everything cool that's going on in Chicago and I'm elevating it so that everybody else everywhere has access to it. And my colleague who covers the Chicago market, but across all the pillars, their job is to find out everything cool that's going around the globe and bring it to Chicago. So we work collaboratively like that to get to a more direct answer to your question, Dennis. The reason for that is because we want to make sure everybody's not working in silos, nobody's reinventing the wheel, but particularly as it comes to the distribution of new products or services, there really needs to be trust within the community, and then oftentimes tailoring of that product or service, where maybe the 90% is the same, but the 10% that makes it work for that market or that entrepreneur, you really need that local knowledge in order to be able to effectively access the community that you're trying to help.
Fantastic. Thanks to everyone. I think we're going to move quickly to some of the questions from the audience.
Yeah, do you want me to go ahead and
yeah, Tracy, hop in, please.
Okay. So there was a really great one that Allegra had answered in the Q&A box, but it was for all of the speakers. How are you sourcing good deals? And also, how are you partnering and collaborating with other funders that have shared missions?
And I think part of that was addressed early on to the fund managers themselves in terms of deal origination.
Yes, I don't know if Todd or Kim want to answer that.
I can kick us off. You know, on the front end, from a deal origination standpoint, we look just like a traditional private equity firm. We know that it's important when we're going out to the market, which can be a novel model. That's important that we're able to interact with brokers and investment bankers and owners in ways that are familiar to them. So you know, we present ourselves as a buyout firm. We do due diligence on companies just like we're a buyout firm. We actually do a lot more. We actually shoulder the cost of a lot of the ESOP related exploratory expenses on behalf of our owners, so they're not paying any more, going through any more difficult of a process than they would go through with a traditional PE firm to some degree. So we try to look as much like the typical PE firm on the front end, knowing and we share early on what our ultimate goal is behind the investment. So yeah, Kim.
So I would say we look at it from a few different points. You know, one, you know, because of the technical assistance or programmatic work, you know, we recognize that the diverse founders that we support generally don't have a pathway directly to access capital. So we intentionally have folks in specific regions to do that outreach and build those collaborative partnerships with various, you know, business service organizations and centers of influence to be able to make that connected tissue. And then we also have specific initiatives and promotions to, you know, do outreach and search out to amplify these diverse employer-based businesses that are not traditionally in the technical, you know, pathways through our job creators grants. The other element is we are involved with a number of collaborative initiatives to you know, share the experience, share deal flow with collaborative organizations. You know, because of the outreach we do on our accelerator side, you know, we may support 1 out of 10 or 1 out of 5 companies, and those other companies, they, depending on where they are in their journey, they may need a different provider of capital in that capital stack. And so, you know, we've been fortunate enough to be invited to participate in a number of initiatives. One of them is the Treasury IIE initiative that we're working collaboratively, to be quite honest, with a few people that are on the call on the funder side that are supporting that to really help you know, supplier-based businesses. So those are some of the practices, and I would be remiss if I didn't say one other thing. You know, as a fund manager of color, it's been an interesting journey. So I have also, you know, mentored, referred, coached a number of people as they go through this journey, and leverage, you know, platforms like what we're doing today to provide people to lift up and say that there's so many people looking at wanting to solve this problem, and this is a great, you know, venue to be able to connect folks. So those are some of the things that we do here at Founders First to really help architect this more inclusive ecosystem to drive an inclusive economy.
Okay. And then we had another question. It was really a clarification, but I turned into a question. Susie and Allegra both mentioned addressing all women as a minority group. Do any or all of the other panelists or their entities do so focusing solely on people of color, or therefore only women of color?
I'll mention just real quickly, you know, we have a pretty broad definition of diversity: women, women of color, women, people of color, LGBTQ, and those in second and third tier regions or LMI regions, as well as veterans.
Yeah, and I just want to clarify that at NMC, we don't categorize women as minorities. We use the standard definition of minorities referring to racial and ethnic groups. However, women if you look from the capital that has been allocated on a gender basis, women have historically been undercapitalized, over-mentored, underfunded. And so just wanted to state that clarification.
For Avison Heritage and Legacy Fund 1, our mandate is to focus on workforces of color, BIPOC workforces, and not a specific carve out. However, some of the industries that we do look to have within Fund 1, such as your home care, elder care. We know those industries do largely over index for women and women of color. Also like to note for us, we're not concerned at all about the demographic of the exiting founder. Both of the companies in our portfolio had white male founders, and we're solely focused on the workforce and what will be a employee owned enterprise.
Okay. I know we had a number of other questions, but just for time's sake, I'll pass it back to you, Dennis, to cover the spotlights for the lenders.
Yeah, I think we wanted to give the fund manager, although we touched on it a bit, but if you had a particular a deal, I know some of the folks have only made a few or are about to make some, but a particular deal or element of a deal, or you could even mention an investment that you closed into your entity. But if the fund managers wanted to highlight a success case and what you liked about it or what you loved about it.
Sure, I wouldn't mind kicking this off. So we've done about 30 investments in our 7-year journey, and super excited about how this is playing out for them. But one particular organization, they are a health ed tech organization that focuses on helping health professionals be able to get cultural relevancy training and the delivery of medical services. This particular organization had diverse founders from physicians to the leadership team, and they were serving their communities, as well as often building business that has a really impactful model. And that's the situation with this particular organization. And I'll just shout them out. Quality Interactions. It's a Black-led, woman-owned company. Their CEO, Ashley Ugodima, they provide online cultural competency training as an organization. Their situation was, while they've been in the market for, by the time we worked with them over 10 years, they had long-standing relationship with top organizations, but they had issues with cash flow because of the long sales cycles, as well as cash flow, collections. But the challenge for them was, they weren't the model that the typical equity funding, growing at 100% year over year, was more like, in the 30s to 30+%, had some really great contracts with some new institutions, but needed to expand their capacity. And we were able to provide them with a revenue-based financing that allowed them to expand their team, grow up their product offering. And 4 years later, they have grown their revenue 4x. They've been on the Inc. 5000 and have been able to create some really amazing premium wage jobs. So, we're looking at making this a representative way to demonstrate that, when you add, 6 figures of capital, this particular was a $400,000 investment, which we did in 2 tranches, that they can strongly get on the path of being a mid-market company, and that they're not an exception, but more the norm.
Thank you.
I'll give one anecdote from the A&H side. We've made 2 investments thus far, but in the accent landscaping example, stepping back, we believe employee ownership is in these models, when done the right way, actually create better companies, stronger companies that grow faster, do better. And the research around these companies shows that that's true. But just a quick example with Accent Landscaping in Texas, at the time of the transaction of the buyout, they had about 115 employees, but they had work lined up out the door, but they didn't have the workforce needed. They couldn't do the hiring that was needed to get the work done, which was very common for companies in Q1, Q2 of last year. We came in May, did the transition, made the announcement to the workforce, implemented the ESOP, while also implementing a significant pay raise that impacted about 75% of the workforce. And over the next 6 months, saw tremendous increase in ability to do contracts, because their headcount went from 115 to one point to about 160, 165. And it's kind of settled around the 160 mark right now. So when we talk about, in a toughening labor market, where workers are looking for and demanding quality jobs more and have options. An employee ownership model is something that can really contribute to worker retention and the principles that come with setting up cooperative enterprises, human-centered HR, open book management, getting employee representation on the board, all these things that from the co-op world that lead to high quality jobs also are going to make a company just have a competitive advantage in the labor market. So we've got stories from the Apex side too, but just for sake, there's one.
Love it.
Yeah, and then we haven't closed on our fund yet. However, I can highlight the success we've seen on the pre-acquisition fund. So we launched this 0% interest loan program with Common Future last year, and it has been such a success that we are now innovating with one of our investors to offer this as a place for donor advised fund capital. So these funds go into NMC, they're recycled. Once an entrepreneur closes, we recycle the capital to other entrepreneurs in the pipeline to help them cover legal due diligence, quality of earnings costs that can range anywhere up to $50,000. And so we are looking for additional partners to join us on providing this source of capital to our entrepreneurs before they even close on the acquisitions.
Fantastic. I think that's the agenda. Zach or Kim, did you want to have any final words? And thank you all to all the guests. This was great. I know there was a lot of us, so appreciate folks sharing and allowing us to move forward. Great conversation.
Sure. I will wrap up with saying thanks everyone for joining us today. You know, as you've seen, investing in an inclusive economy is not a vision, but it can be achieved with the steadfast, courageous leadership of our asset allocators that you heard from today that are willing to be intentional with their portfolios and combined with visionary innovation of diverse fund managers to bring this new creative capital to entrepreneurs that have too often been overlooked. We look forward to continuing this conversation and working together. And thank you again for joining us.
Thanks, everyone, and thanks to the audience. Take care, everyone.